Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I am joined by none other than Rick Rule, legendary mining investor and the CEO of Rule Investment Media. We are going to get his current thoughts on the metals and mining sector, whether he thinks the broad market is overbought and due for a correction, his thoughts on the Liberal government in Canada moving to force oil and gas companies to cap emissions, and so much more. I hope you'll enjoy my conversation with Rick Rule. Rick Rule, great to have you back on the show. I want to start things off with a broad question and pick your brain a little bit. I'd like to know what is forefront of your mind right now when it comes to financial markets and the economy.
Well, that's a broad topic. I guess most people are looking at the market's response to the Trump victory, which I suggest is mostly a whole bunch of to-do about nothing. I'm much longer oriented. And as always, I'm trying to figure out what's cheap and what's not cheap. And among those things that are cheap, those things that I understand. I look at the broad landscape as an example in the United States market. And despite the fact that I'm starting one, I think community banks are really cheap. Uh, People are pricing them as though other folks won't need banking services for the next 30 years, which is absolutely stupid. Uh, I think that there's a lot of indecision around the good, the bad, and the ugly among the uranium stocks, and people tend to value them the same, although there's vast differences between the companies. So I'm trying to take advantage of that. When I look at the investment landscape going forward, of course, all things change, but I'm struck by the similarities between the circumstances that confront us now and the circumstances that confronted an earlier generation in the decade of the 1970s. Incipient inflation and the lack of understanding about the way inflation impacts the purchasing power of one's savings, and the potential both to decimate the long bond market, decimate savings, and reward those investors who participate in alternatives.
I was just going to pull on the thread there regarding community banking looking undervalued at the moment. That's a sector, obviously, we've never discussed on this show. I'm wondering, from your perspective, what are you seeing there that makes those valuations attractive? And how do you go about evaluating a company like that, a community bank?
I see some little banks that have consistently generated uh, 15% plus after tax uh, returns on equity, and I see these banks selling at a discount to book. The idea that I can buy a well-run local franchise that's generating 15% after-tax return on equity, selling for 70 or 80% a book, is the same thing as as being able to buy 18, 19, 20% internal rate of return, and I'm attracted to that. Uh, some bank investors look at the great big banks, the too big to fail banks, and they look at the fact that because they have the implicit federal guarantee, that their cost of capital is very low. People are willing or stupid enough to deposit money in the big banks for no interest. Some little banks, including my own, are beginning to make some inroads on that. It's surprise, surprise. People, when they take the risk of depositing money, would like to get paid. It is a truism that the little banks can't compete with the big banks. It's a less known truism that the big banks can't compete with the little banks either, because the little banks have expertise in their region or have expertise in their industries that the big banks simply can't afford to have. But that's narrative. What really attracts me is businesses that have historically generated 15% plus after tax returns on equity. Franchise like that, management teams like that, selling at 70 or 80% a book. There will come a time when those banks will be bought at 2 or 2.5 times book, having increased book at 15% compounded for 6 or 7 years. Um, that sounds like an awful lot of fun to me, and nobody cares.
Hey guys, just a quick break to hear from today's sponsor, ARC, Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Very interesting. I want to follow up with another sector that nobody cares about, where majors are also selling for 70% a book, and that is the fertilizer stocks. Big companies like Mosaic, Nutrien, something I don't talk about a lot on the show, but I've been looking at the valuations of these companies and being very shocked by how undervalued they seem to be. The only correlation I can make between a lot of these stocks have collapsed quite a bit over the last few years. It seems to correlate with the drop in the potash and phosphate prices. I'm not certain, but there seems to be some connection there. Are you looking at the fertilizer stocks right now, and what are your thoughts on the sector?
I've owned those two stocks for a very, 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 very long time. And they're certainly cyclical stocks. If one owns them through the cycle, which I do, um, they perform extraordinarily well. In addition to that, people knock them because they're slow growing industries, which in fact they are. But they are both companies that have been reasonably successful at vertical integration, which is unusual. And they are companies that generally have, within a band, decent returns on capital employed. And because they're slow growing, they're usually kind enough to return uh, a fair bit of their income to shareholders by way of dividends, and those are in fact earned dividends. Investors in the space need to be very concerned about the outcome of a peaceful resolution in the dispute between Russia and the Ukraine. When the Russians come back into the phosphate market, they are the world's lowest cost producer. For a while, that's not going to be a problem because the Russians have deferred sustaining capital investments. It seems the Russians have had other uses for money. And if you defer sustaining capital investments, you impair your ability to produce in the out years. We saw the Russian potash industry take 5 years to recover from the reorganization of Russia in 1989, 1990, 1991, the last time that the Russian state needed money to the extent that it needs it today. So, assuming, first of all, that peace occurs in the Ukraine, which I hope happens, there will be a time when the Russians and their friends, the Belarusians, uh, retool their domestic industry, which will give the West some breathing room. When they retool in the potash industry, you need to understand that Russia can be the lowest cost and highest volume producer on the planet.
That's a great insight.
That would be my only caution. I think too that 5 years from now, not immediately, but 5 years from now, the price of all nitrogenous components goes up. Natural gas is too cheap right now. It's produced as a byproduct of oil. The consequence of various technologies coming together with a very low cost of capital has meant that U.S. oil production, in particular, but Canadian oil production too, has surged, and byproduct gas production has surged. The BTU arbitrage between oil and gas is too high, and billions of dollars are being spent on monetizing that arbitrage. Over 5 years, that'll be successful, but it won't be successful in 2024, 2025, 2026. The bottom line of that is that natural gas prices will rise. The consequence of that is that nitrogenous fertilizer prices will rise, and that will impact all the way down to the farmer. He or she will have to pay more for nutrients, but the nutrient distributing companies will have to pay more for that input.
And how do you evaluate natural gas markets? Because I've spoken to even people who are experts in the oil market, and they say it's so complex to evaluate that market and to understand it because of all the price differentials in different jurisdictions and all of the myriad of factors that drive the natural gas price. Of course, it's known as a widowmaker trade for people who try to trade it short term. How do you take a step back and look at and try to understand the natural gas market?
Because I trade it in a 5 year term. I don't attempt to trade it short term. As you suggest, there's so many variables that trying to understand the short term market is trying to know the unknowable, which is a waste of time. But I like big math, Jesse. I like really, really, really big math. So let me give you some oil and gas big math. The price of U.S. natural gas, Henry Hub, is about $2 per million BTU right now. Uh, Canadian gas is even cheaper, $1.50 Canadian, about $1 US ACO. That same gas per million BTU landed at Rotterdam or Tokyo or Shanghai uh, goes for 8.5, $9 US. uh, Takes a couple bucks US to get it there. That arbitrage is too great to continue. And there are billions of dollars being spent every month to address that arbitrage. Gas storage, gas gathering, gas processing, gas transmission, liquefied natural gas, deliquification plants, tankers. When you have an arbitrage that broad, against a different arbitrage, which is the BTU arbitrage between oil and natural gas, the energy differential is about 6 to 1 per barrel against a million BTU, 1,000 cubic feet of gas. Uh, Gas is selling at more than a 50% discount to BTU dollar parity. So you have these two arbitrages, one, the gas to oil arbitrage, and the other, North American to Europe or North America to the Asia. Market inefficiencies in markets that are measured in the tens of billions of dollars. Market inefficiencies of that magnitude, a 60 or 65% gross selling price inefficiency, get arbitraged out. Will I be right in 2025? Almost certainly not. Will I be right by 2030? Absolutely, positively, without a doubt. I've told you before, Jesse, that I love questions where the answer begins with when, not if. And that's what natural gas is. And mercifully for me, most of my competitors, including some of the biggest investors in the world, invest with a long term narrative, but they use a short term tactic. In other words, they invest in something with a 5 or 6 year outcome, and they have stock. They have trauma holding stock over a long weekend.
Yeah, I think time horizon is so important. I want to switch to the mining sector at the moment because last time I had you on the show, you said you were delighted at the disgust of participants in the mining sector and you were taking advantage of some bargains. It doesn't seem a whole lot has changed. Uranium doing quite well now, but when it comes to like just looking at the major gold producers, for example, Newmont and Barrick have both fallen off a cliff along with a lot of other gold companies. Are you still buying at this moment when it comes to the mining sector? Where are you seeing the most opportunity at present?
I in fact am. The gold mining sector is, I think, discounting what I see as 10 years of deterioration of the purchasing power of the US dollar. That's disguised because the US dollar is outperforming all the other currencies, which is to say that the US society, despite the fact it's very competitive, is losing the race to the bottom relative to the others. And so, perversely, while gold is very strong in currencies outside the US dollar, it's weak in the currency it's measured in. I think that'll change for reasons we can talk about later if you want to. But the gold mining industry is behaving rationally right now. They are rewarding companies that are performing, and they're penalizing companies that aren't. All-in sustaining costs are stubbornly high at both Barrick and Newmont. Uh, Cash margins have been less buoyant than one would expect, given the increase in the selling price of the commodity that they produce. Margins have been expanding at places like Agnico Eagle, and they have consistently beat guidance. The consequence of that is that while Newmont is down, Agnico Eagle is up. Surprise, surprise. A company that performs does well. A company that doesn't perform does poorly. Now, I happen to believe that the business plan at place at Newmont is an intelligent plan. I also believe it's going to take a year and a half to play out. If you are willing to bet that they can implement the plan, you could invest now in anticipation of the successful resolution of that plan. By the way, to save your listeners a bunch of reading, the plan is that Newmont, after the Newcrest acquisition, will sell basically all of their Tier 2 assets. They operate too many mines now, and their management time and attention and their sustaining capital budget is split between too many competing mouths. The idea that they would take advantage of a very buoyant property market, which we're in right now, to sell the Tier 2 assets, use the cash to pay down their debt, and focus management love, time, and attention, and also sustaining capital on 5 or 6 assets that matter, is a really good plan. But they have to do it. If they are successful in doing that, of course, the gross ounces that they produce will fall. That will happen. But the margins will expand. And the all-in sustaining capital costs will fall. The other thing that your listeners need to understand that is very difficult to understand is that the returns on capital employed in optimization are often double or triple the overall returns on capital employed in an operation. If a mine is put in production with an ROCE in the feasibility study of 20 or 25%, that's one thing. But after the mine is in production, when you're making smaller investments in optimization, retooling a mill, increasing the size of the haul trucks, increasing the size and efficiency of the shovels, return on capital employed in optimization can be 50%, 60%, 100%. Two, big mines are almost always put into production when there is enough reserve and resource to amortize the upfront capital expense. But those mines, in every case I'm aware of, deliver upside exploration surprises after near mine exploration commences, which is to say a mine with a 12-year mine life often produces for 18 years or 20 years. I look forward to Newmont benefiting from selling their Tier 2 deposits, improving their balance sheet, focusing their love, care, and attention on optimization, and expanding the mine lives in their Tier 1 operations. That plan will work if they implement it. It will be up to your listeners in terms of how their own portfolios do to monitor Newmont and Barrick's adherence to their plans.
And a quick follow-up question there where we're talking about the big gold producers. I wonder what your thoughts are on Franco Nevada here. Obviously, they suffered a major blow with the loss of the Cobre Panama mine. That situation is still ongoing. Who knows when it's going to get resolved. Meanwhile, I should say, Wheaton Precious Metals has been doing outstanding. I guess the second biggest streaming company in this case in the royalty streaming category when it comes to precious metals. Do you see Franco Nevada as undervalued today?
I see Franco as fairly valued. It hasn't been fairly valued for a long time. It's a gift. Arithmetically, people invest in narrative, but they should invest in math. Arithmetically, Cobre Panama accounted for about 15% of Franco's net present value. And when the government of Panama took Cobre Panama, Franco's share price declined by 42%. So the disparity is between 15% and 42%. The second thing that somebody needs to consider is how much of this will Panama get away with? The nationalization of Cobre Panama abrogated sovereign contracts, and that still needs to be handled in arbitration. The realistic claim that the interest holders have, including First Quantum and Franco Nevada, likely exceeds 10 billion US dollars. What might the Panamanians use for money? My belief is that that asset isn't gone for good, or if it is gone for good, the ultimate settlement between the Panamanians and the interest holders isn't factored in the market at all.
That's a great evaluation. Does this speak to an issue perhaps of Franco Nevada having too much exposure to one project? What are your thoughts there? Is that something one needs to be aware about when evaluating a royalty or streaming company?
You know, a couple things. Buffett famously says, "Put all your eggs in one basket and watch that basket very closely." The truth is that Nevada's premium royalty is Northern Nevada. That doesn't suggest, by the way, that there aren't real political risks in the United States, but that's a very different question. What Franco Nevada has managed to do mostly is concentrate on very, very, very high quality assets. They have come down the quality trail because they've been impatient. When the ability to attract high quality assets gets scarce, the temptation is to do something. With For me, with regards to both Franco and Wheaton, what attracts me about them is that we are in a new era of mine finance, particularly in the copper space. And building a copper mine with gold and silver byproduct credits is an extremely expensive endeavor. If you are having to raise $8 billion, as an example, you need to utilize all aspects of the credit stack. Gold or silver cash flow in a copper producer is valued at 6 times EBIT. That same cash flow, limited to gold or silver as a stream or a royalty in a precious metals company like Wheaton or Franco, is valued at 15 times EBIT. That's too great an arbitrage to ignore. This new cycle of mine finance, and separately, a cycle where sovereign governments in emerging markets want increasing equity shares in mines but can't pay for them, and could pay for them through the sale of a royalty or a stream to somebody like Franco or Wheaton, means that the companies with the financial means in the next 5 to 10 years are going to have the opportunity to deploy billions of dollars in tier one deposits that will generate free cash for 20 or 30 years. The knock on both Franco and Wheaton is, how do they grow? And the answer is right there in the market. The arbitrage between precious metals cash flows trapped in base metals producers or crystallized in a stream on behalf of a royalty and streamer is the difference between 5 or 6 times EBIT and 15 or 20 times EBIT.
Well, we've just been discussing big producers, royalty and streaming companies, less risky bets for the most part. I think you would agree when it comes to the spectrum of mining investments that are out there. However, there seems to be a pervasive mentality, especially when you look at social media, of people who are seeing, maybe it's a meme coin cryptocurrency thing where people want these 10x, 100x returns. I've literally spoken to people in the mining sector about certain companies, and their comment is, oh, well, that doesn't stand any chance of 10xing, so I don't even want to deploy capital to it. From your own perspective, how do you approach position sizing in that when it comes to the junior resource stocks? You've mentioned before on this show that very few of them actually end up being successful. So it's very difficult to evaluate them. But when it comes to position sizing, should your average investor out there be more focused on these larger, more sure things, ETFs, the physical metal, et cetera, and then be allocating a smaller amount of perhaps gambling money or speculative capital on these junior mining stocks?
It's entirely a function of how hard that investor wants to work and what their tolerance for loss is. Jesse, at the beginning of my investment career, I was insanely speculative. But let's put that in context. I was co-owner of the most popular bar in Vancouver, a bar that was frequented by Murray Pesum, Adolf Lundin, Billy Rand, uh, Peter Brown. And I literally, not figuratively, literally would pour these guys drinks and ask them questions. Run back in the back, write down the answers, come back, pour them more drinks, ask them more questions. I worked very hard. I had great, great, great access to information. I was present at tables where deals and transactions were taking place. Not that I traded on material non-public information, of course. Uh, Suffice it to say, I had a definable competitive advantage and I worked very hard. And because I owned that bar and I had dependable free cash flow, and because I had invested in a couple of triplexes where my cost of capital was fixed, but my return on capital employed continued to increase, I could afford to be extremely aggressive. And I was extremely aggressive. All of the money that I now invest carefully, I made by speculating wildly. But I worked hard, Jesse. I had advantages. Somebody who lives in Vancouver, somebody who is willing to go up to Ross Beatty when he's at Tim Horton and ask him a question over coffee. Someone who reads insider reports, who reads resource calculations, who reads PEAs, that person should be aggressive. That person should be very aggressive. A smart, hardworking person who knows the difference between volatility, cyclicality, and risk, who lives in Vancouver, who can participate in private placements. There's just no excuse for that person to make $1 million in the next 5 years. But remember all of the classifications, all the categories. That same person, if he or she lives in Omaha and doesn't isn't willing to work hard, that person needs to be involved in beta, not alpha.
Love that answer. Very nuanced, and it definitely depends on each individual. I want to switch to the broad market for a moment because I have a lineup down the block of guests on this show who pound the table that it's massively overvalued. We're due for a steep correction. It usually ends up either as a slow grinding decay or it's going to crash, 20%, 30%. I've heard 90% from some guests. However, I was listening to an interview with Howard Marks the other day, and his answer, Howard's amazing at giving these short answers, but yet having so much insight in them. He said, I don't really know. And that's because that's not an area that Oaktree is involved in. We're in a different category. And I haven't taken the time or made the effort to try to completely understand why the broad market is where it is and if it is or is not due for a correction. And that was kind of the end of his answer. And that I found that very refreshing. I'm wondering what your thoughts are here. Is this a classic bubble like so many people are proclaiming it to be? Obviously we've seen Warren Buffett take the biggest cash position in Berkshire Hathaway's history. A lot of people think he has some information behind the scenes that maybe most people don't have. Putting this all together, what are your thoughts on the broad market?
Well, I like Howard Marks' remarks a lot because they coincide with the way I think. I know a lot about natural resources, and I know a lot about conventional financial services, insurance businesses, banking businesses, agency businesses, and I don't know very much about anything else. So, like Howard Marks, I have no idea if tech stocks are overvalued. Uh, I don't know how to do net present value calculations on businesses that are growing quickly but don't make any money. I don't know how to analyze consumer durable businesses or entertainment businesses. I believe that the cost of capital will go up. I believe that the market would like to take interest rates higher, although the big thinkers would like to take it lower. So I'm cautious. And I take Buffett at his word. Buffett said he wasn't building cash as a tactic. He was building cash because some of the businesses in his portfolio were, by his measure, overvalued or fairly valued, and he couldn't find other places to put the money. He sees himself as being opportunity constrained. Now that may be a market call. He's pretty good Uh, I mean, yes, he's invested what for him is pocket change, $250 million in Domino's Pizza. But pretty obviously, when you're coming off, I don't know, $100 billion worth of sales of Bank of America or Apple, you can't put all that money in Domino's. And I think he is finding a difficulty investing in companies with some sort of moat that have good margins, that are big enough for him to participate in. I It's interesting when I look at his criterion. The industry that stands out to me, he's been a big investor in, which is to say the oil and gas industry. Um, it may be that I'm falling for my own bias in that I'm attracted to the oil and gas industry. It may be that there's something in the out years that he sees in the oil and gas industry that I don't. But when I look at intelligent balance sheets, high margins, return on capital employed, I notice that the industry as a whole is not making sustaining capital investments, which is problematic. If you don't invest cash flow now, your means to generate cash flow in the future gets constrained. But there are companies in the sector that are making the sustaining capital investments and the new project investments while simultaneously rewarding shareholders. It's a mystery to me, and frankly, a concern to me, that Mr. Buffett isn't devoting more of his portfolio to oil and gas. It makes me wonder what he knows that I don't know. Maybe, unlikely. I know more about oil and gas than he does. He has focused on a lot of industries. I've focused on three. But I'm concerned about the fact that an industry that meets his criterion so specifically, where he's already invested, isn't capturing a larger part of his wallet share.
For investors who are looking for yield right now, is there anywhere in the fixed income market that looks attractive to you at the moment? Corporate debt, emerging market debt, government bonds. What are your thoughts?
Nope. Nope. I'm a credit guy. Um, I love, I think the worst piece of debt is better than the best piece of equity on any individual balance sheet. But I don't like the direction of interest rates, and I don't like duration. I own, relative to most people, a lot of U.S. Treasuries, and I don't own a duration longer than 2 years. The interest rate curve between the short and the long is stupidly disproportionate in terms of risk. And the part of the credit market that I've specialized in most of my life, which is below investment grade, is insanely overpriced. People have chased yield without any understanding of the covenants and conditions on the bonds that have been issued. Wall Street has unleashed a torrent, trillions of dollars of debt that is junk debt in the truest sense of the word. Uh, I remember the junk debt market, the below investment debt market in Canadian oil and gas companies in 1988, 1989, 1990, 1991. You could buy bonds with a cover yield of 12% that was being earned, and you could buy those bonds, 4 or 5 year bonds, at 60% of par, which meant that you had an 18% running yield and a 25% yield to maturity. And the bonds were covered by net present value in the first instance and by free cash flow in the other circumstance. You don't see that in the high yield market anymore. You don't see it in a market that I'm familiar with. I would point out something else to you, Jesse. Um, the credit market, the yield market, uh, is driven by a desperation for yield. And I think that yields are actually negative. People who buy bonds believe that a deterioration of the purchasing power of the US dollar is a function of the CPI, which is to say the bogey is 2.6%. I think the CPI understates the deterioration of the purchasing power of the US dollar substantially. When I look at the basket of goods and services that I buy, Jesse, I would suggest that the deterioration of purchasing power of the US dollar is more like 7.5%. I'm not somebody who thinks that the US dollar relative to other currencies is a bad currency. Our mutual friend Doug Casey says the US dollar is the worst currency in the world except all the others. But I'll tell you that the CPI as an index is stupid. It doesn't include tax, doesn't include food or fuel. I mean, any index that doesn't include lunch is of no use to me. So for me, my bogey's 7.5%. The idea that I'm going into a 5-year junk term at 6.5%, which suggests that I'm losing 1% a year in purchasing power while taking real risk, is an insanity to me. As long as I'm on the tangent, Jesse, let me go a little further. The sector that scares me the most for retail investors is the high yield ETFs, the junk bond ETFs. There are trillions of dollars invested in these things by people who don't know what a bond covenant is. They look at the disparity in the yield on the ETF between that and the deposit yield that they get at their major bank, which doesn't pay them interest. And greed drives them into the ETF. Now, the Topco, the ETF, is extremely liquid. They trade billions of dollars a day. But the constituents of the ETF, the over-the-counter traded junk bonds, are extremely illiquid. If the American investor began, say like in 2008, to begin to be concerned about credit quality and sold the ETF, the managers of an extremely liquid instrument would have to sell the underlying instruments to satisfy the redemptions. To who? You may have heard me refer to those illiquid bonds as owl bonds. An owl bond is a bond where you call your broker and ask him or her to sell it, and they say, to who? To who? The idea that we would have disintermediation from the ETFs into a market where there's no bid is equivalent to a bank run with no treasury backstop. Truly scary.
Well, speaking of things that are insane, I have to get your thoughts on the Liberal government in Canada now moving to force domestic oil and gas companies to cap emissions. This is a quote from the National Observer. The Liberals said capping oil and gas pollution is crucial to cut greenhouse gas emissions while ensuring the industry's competitiveness through the energy transition. However, Ottawa's fiercest critics were quick to slam the proposal that aims to cut 1/3 of the sector's emissions by 2030, setting up further rounds of conflict for Prime Minister Justin Trudeau's beleaguered government. Is it time to sell Canadian oil and gas producers? Is this going to really affect the bottom line if it does fully get implemented? Do you think this plan will ultimately fail? How are you seeing things?
I think it's time to buy the Canadian oil and gas producers. It amuses me that your prime minister seems to be even dumber than our presidents. That takes really special skill. He seems to believe that he's bigger than a market. And again, let's look at the arithmetic. I don't want to attack him based on narrative. He's better at narrative than I am. He's pretty, young, slender. I'm old, fat, bald. But I'm good at math. So let's look at carbon first of all, okay? And let's look at alternative energies. With regards to carbon, first of all, the emerging market nations say that carbon shouldn't be measured by nation. It should be measured by per capita. So the fact that the Chinese produce 50% more carbon than the United States does is a function of the fact that they have 4 times as many people. With India, the situation is more stark. Furthermore, and by the way, I think they're right. I think if you're going to penalize people per carbon, you have to look at people as being the same, irrespective of their nationality, which means that all of the cost has to be borne by the West. A second circumstance is that emerging and frontier nations, call them the global South, suggest that current carbon loadings are 2% of the problem, that 98% of the problems are historic loadings. And those historic loadings are all the property of the West. So if you are going to impose the carbon agenda, understand that all of the costs of carbon are going to be borne by the West. Now, to take a look at the impact of that, one needs to look no further than Germany, where power prices have quintupled and where they are literally now having to tear down wind farms to expand coal mines. What about alternative energies? Your prime minister will say. I would point out to him, first of all, that in northern climates, the sun doesn't shine much. And the idea that you rely on solar energy when for half the year the sun doesn't shine very much is arithmetically challenged. But a bigger challenge looks at history. We have, over 40 years, spent $5 trillion on alternative energy power generation. By the way, I've invested in alternative energies for years, sometimes successfully, sometimes not. That doesn't matter. We've invested in alternative energy generation for 40 years, almost $5 trillion. That $5 trillion investment has reduced the market share of carbon-based energy from a high of 82% to a low today of 81%. Now, I could understand how Mr. Trudeau would have a problem with that math. He's waiting for his budget to balance itself. But my suspicion is that given the fact that oil and gas is the generator of all of the transfer payments from Alberta, where Canada's money is earned, to Quebec, where Canada's money is spent, that even the Quebec electorate is more numerate than the Prime Minister. There's more math, too. I do like to take him on in math because, as I say, he's easier to like than I am. When he says there's no business case for Canadian natural gas, Canadian natural gas sells at AECO for $1.50 Canadian per million BTU. In Canadian dollar terms, it sells for $12 a million BTU. Frankfurt, Rotterdam, Shanghai, Tokyo, and it costs about 2.5 Canadian bucks to get it from southern Alberta to those markets. Transport, liquefaction, deliquefaction. So landed 4.5 Canadian bucks, it sells for 12 Canadian bucks. And there's eager buyers. And he doesn't see the business case. I do. I think anybody who can do simple arithmetic does.
Well, Rick, this has been another fantastic conversation. Greatly enjoyed it, as always. Can you tell us about Battle Bank and also Rule Investment Media for people who want to submit their portfolios to you?
Yeah, let's do them in reverse order. Um,
Sure.
the amusing thing for an old guy like me really is investor education. I like doing it, so I do it for free. Any investor who cares what I have to say about natural resource investing can personalize it. Go to my website, ruleinvestmentmedia.com, list your natural resource stocks. Sidebar, no crypto, please. No pot stocks, no tech stocks, just something I can do. Anyway, no charge, no obligation. I'll rank your portfolio. And if there are any companies in there that I think I know something special about, I'll comment. Be a little patient. I'm 6 or 7 days behind. So if you don't get a response the same day, understand I'm a tired old guy getting ready to go to the New Orleans conference. Ruleinvestmentmedia.com, list your natural resource stocks. Battle Bank is a different situation. If you're uncomfortable with your current bank, and I don't know anybody in the world who isn't, check out Battle Bank. People go to the big banks because they're allegedly too big to fail. They're confronted with 15 or 16 savings products, 5 or 6 of them, pay them no interest. That seems really stupid to me. Battle Bank has one high yield money market account. You want to write checks? Write checks. If you prefer to be paid interest on your deposits as opposed to not be paid interest on your deposits, check out Battle Bank. By the way, for your listeners, if you own physical gold and silver, the big banks Canadian and American, don't consider that to be good collateral. Rick Rule does. If your gold and silver is in a segregated account and you want a credit facility so that you can take some of the value of your gold and silver, buy a summer cottage, put down a down payment on a duplex or a triplex, buy more gold or silver. For some reason, the big banks don't think that gold and silver is good collateral. I think it's spectacular collateral. So if you would like to access credit on your physical gold and silver, and for some reason your existing bank doesn't do it, check out Battle Bank. Go to battlebank.com or on the same Rule Investment Media website that you listed your natural resource portfolio on, under questions and comments, simply write in bank.
Great. Well, I will put links in the description below to Rule Investment Media as well as Battle Bank's website. Thank you once again, Rick, for coming on and sharing your knowledge with the audience.
Jesse, I enjoy the process. I like the fact that you work very hard preparing for an interview. It's delightful that you don't ask me dumb questions, for which I thank you. It's a pleasure talking to your audience through you, and I look forward to visiting with you again if we don't talk before then. Enjoy the holiday season.
And thank you for joining us today. This episode is brought to you by ARC, silver, gold, osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.